Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, top of the top go kind of thing today is Wall Street returns to a T+1 stock trading after a century. Only in Bloomberg would people read that kind of story. And maybe I'll find one other person that cares about this stuff. Larry Tabb. He's head of market structure at Bloomberg Intelligence. Larry, can you explain to us what is going on here? Explain it like I'm 5 years old, because when I started in the business, I think it was T+7. That was a gentlemanly time frame. Now it's T+1. What's going on?
Not a problem, Paul. Yeah, starting today, securities traded today will actually settle tomorrow instead of on Thursday. So what that means is that I buy Apple today, and on tomorrow I get the shares in my account, and my broker takes the payment out of my account. Now, for most retail, it's not going to be that big an issue. It's much more of an institutional issue where the securities and cash don't reside at the broker, where they reside at a third-party custodian, and that becomes a little more complicated.
So how does it become complicated? Like, it seems like a pretty straightforward thing, right? So where do the problems lie?
Well, their problems will lie in 4 or 5 different areas. The biggest problem is with foreign exchange. So let's just say I am Aberdeen and I'm located in Scotland or wherever, or in London. If they buy Apple, they're going to have to actually send over currency, pounds, and convert that to dollars and pay for that. The problem is that currency takes 2 days to settle in standard currency settlement, whereas the securities will settle in 1 day. So if they buy Apple today, we'll have to pay for the securities tomorrow. But if they send over pounds to pay for that, to cover that, the pounds won't actually get converted to dollars till Thursday, which means they won't have the cash there on time. Which means they either have to finance that purchase, or they have to move the cash earlier, or they have to, instead of using SWIFT or CLS, which is the currency settlement system, they actually have to call somebody and say, hey, let's do this on an emergency basis and get this taken care of. And so that's an issue. The second has to do with securities lending. So if my Apple's out on loan, they have to get that back so that I can actually make sure that can get delivered. Now, Apple's probably not a big issue there, but if it's a hard to borrow security, it might be much more difficult to find the securities. If I've lent them out to try to collect a fee, getting them back may be a little bit more problematic. Other issues which impact actually everybody in the U.S. is the allocation confirmation process. So if I'm Fidelity or if I'm a big asset manager, I'm not buying 100 or 200 shares of Apple. I'm probably buying 100,000 or 1 million shares of Apple. Trades these days don't necessarily occur in these big blocks like they used to. They get broken up into algos and they get executed in 100-share increments. That said, the 100-share increments don't settle immediately. They have to be batched up. You have to create an average price. There's a lot of manual, or at least what used to be manual effort involved in managing that. And the process just needs to be sped up. And the closeout time is generally 9 p.m. for that. And so they have between 4 and 9 to get all that operational stuff done. And that just takes time sometimes when it becomes harder to add all this stuff up and average price it out and break them up into the transactions, because it's probably not 1 million shares of Apple for one Fidelity account. It could be, 10 different portfolios that are buying Apple, and it has to be broken up into, 10 little clumps. And there are a couple of other issues, but those are the big ones.
So given all that, why is the SEC doing this? Is it simply because, from a technological perspective, they can?
Well, the SEC can do a lot of things, but increasingly people are suing the SEC, so they can't do anything they want. I think the issue here revolves around the Robinhood issue back in January of 2021, where they got a margin call to come up with $3 billion to cover all the meme stock buying. And so there's an old saying in the back office that nothing good ever happens between trading and settlement date. So the challenge there is that if for whatever reason XYZ broker goes bankrupt, on one day, the shorter the settlement period is, the more likely that those transactions get paid for, and they don't have to be funded by the industry. Because right now, what happens is all these transactions wash through the DTCC. The DTCC, the Depository Trust, guarantees settlement. So if, God forbid, a broker goes down, the other side of the trade isn't broken. But to do that, they have to take margin from virtually the whole industry. And so if you shorten the settlement cycle, the risk of failure goes down. And so the amount of margin that you have to put up to guarantee those trades goes down. And so it just takes less risk. It takes risk out of the settlement system.
So Larry, with that in mind, how long are we going to know? At what point will we know if T+1 is working or if the difficulties are cropping up? When are we going to know that?
Well, it depends on who we is. The brokers and the custodians and the folks involved in the transactions will know pretty quickly. The problem is that data to the rest of the public probably won't be known for a while. And where we expect to see problems occur would be in the fail numbers. So if I'm a European, if I'm Aberdeen and I have to pay for Apple in the US and my payment doesn't come in, two things will either happen. One is that I'll have to borrow cash from my bank, in which case we may never know about it because it'll just wind up being a loan from XYZ Bank to Aberdeen. Or two, the securities will fail. And then the fail numbers come out on a delayed basis, so we won't know what the fails wind up going up for a couple of weeks. And so that's where, and the third issue is that if all hell breaks loose and we have a real problem, that'll be known in the back offices before anything. And the question is, what kind of transparency will we get out of it? Maybe we'll know some stuff from the Federal Reserve if things go drastically awry, or the DTCC or SIFMA. But they're going to have to publish that information. It's not like something that we could see on a screen, on a Bloomberg screen. A lot of that stuff is fairly private data.
All right, Larry, we're going to have to leave it there. Great stuff. Larry Tabb, head of market structure, Bloomberg Intelligence. He is on top of it. He is the leading voice in the marketplace about how all these markets actually work. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, this is how it was described by our next guest to me the first time I met him. The biggest company you never heard of. For me.
I love this.
I'm like, where was I? This is a $50 billion. This is Arthur J. Gallagher and Company. It's an insurance company. I don't know anything about insurance, so maybe that has something to do with it. But it's $54 billion in market cap. I mean, it's up 10% this year, the stock, up 23% over the trailing 12 months. It's just up and to the right every year. Why haven't I paid it more attention to this one? But thankfully...
And it's like a family business.
I know. Great-grandfather. Pat Gallagher joins us here, great-grandson of the founder. He's the chief executive officer of Gallagher Insurance. Pat, talk to us about your company. You're based down in Chicago. Talk to us about a typical customer of yours and a typical piece of business you do for your customers. What are you guys really focusing on these days?
Well, first of all, Paul, we're not an insurance company, so we don't take risks. We're insurance brokerage.
So what we're helping how much I know or don't know.
That's right. And it was my grandfather who started the company, not my great-grandfather. But anyway, every single day we get up and we talk to customers about what the things are that are facing them that could cause real disaster in their business. So this can be a business as large as any of the largest companies in America with professional risk management staff, all the way down to the smallest of companies that you know in your neighborhood. And each of these businesses faces all kinds of complex risk that's becoming more complex as we sit here. We never ever thought of cyber 10 years ago. Cyber is a huge risk. Everybody's concerned about it. I tell our production force, if you're talking to the largest company in America or you're talking to someone who owns nothing more than a sundry shop, they've got to be concerned about this. And now you add AI to that. And so you see the world everywhere. On top of that, of course, you've got climate change and weather-related issues that are happening across the world, which is one of the reasons why you see such a difficult time, for instance, getting homeowners insurance in places like southern Florida. The point is that every single company, every single organization out there faces these risks. What do they do with them? Insurance plays one role. The other part of a broker's role is to say there's some things that aren't insurable. Now, how do we deal with that? What are the things we do to help you control that? So we look at a full spectrum of risk for a client and say, these are the things that we can do to help you deal with that as you go forward. And that is incredibly valuable. We have a survey that we're just finalizing the details on now. We talked to about 1,000 business owners across America. And it's interesting to me because it really is a finger on the pulse. They're very concerned about weather-related issues.
Oh, yeah.
Weather has all of a sudden gone from something that's important on the coasts to something that's important everywhere. I mean, I grew up in the Midwest. We never had tornadoes in the fall. Now that's normal. So just unfortunately a week ago in Iowa, there was a terrible storm. So people are worried about that. They're worried about tech.
So what kind of customers come to you and you say, and they're like, I can't get coverage on this, or like, I need coverage on this, but I can't get it, or how has that conversation evolved just in the last 5 years? Oh,
it's huge. So let's first of all, a big part of what we do is help people take their own risk. So that can take the form of a large client creating a self-insured platform where we insure excess of large deductibles. It can also go down all the way to the middle market where groups band together to form captive insurance companies. So the first line of defense, of course, is to look at all this and say, what's insurable? Okay, you've got plants in Iowa, you've got plants in Naples, Florida. How's that going to shake out? What's that going to look like? Secondly, you've got workers. You have to insure the workers' compensation. Those types of things you check off the list first. Then you come back and say these things either shouldn't be or can't be insured. And there, Alexis, is really the point of differentiation, because that's where we bring an expert in. To your point, if you ask anybody out in the marketplace, not everything's insurable. Who's going to help me? Well, if you happen to be a builder, that's a different answer than if you happen to be a school district or university. So you have to have people that talk that language. And that is really what differentiates us. It's not just about quoting insurance.
And you're a global business. Talk to us about the business here in the U.S. versus maybe some of the other bigger markets outside the U.S.
So we are a global business. We like to say that any account of any size located anywhere in the world we can do and we can be helpful to. If you look at the United States, though, we have a very interesting business here in that it's incredibly fragmented. Right now we have 30,000 competitors. Those aren't people, those are firms. So in your local community, you drive by Main Street and you'll see Jones Insurance. That's a competitor of ours. So it goes from those 30,000. In business insurance, the top 100 went all the way down to 35 million, 36 million in revenue. We did about 10 billion last year. And the other 29,900 are smaller than that. So it's this incredibly fragmented business with professionals of all sizes and sorts around the country that we have a very strong platform of acquisitions. And we bring those people in. We don't want them to leave us. We feel that 1 + 1 can equal 5. Paul, you're in your community, you know your people, you're very good at insurance. But when we bring our capabilities in, when we bring our data and analytics, now that big account in town, that large contractor, the large university that you knew you had to stay away from, let's go get it together. And if that energizes you, you'll be a great fit for our acquisition team.
You're going to sell insurance?
No, but the people I know that sell insurance do very, very well. And you spend a lot of time on the golf course, too, which I don't figure out that business model.
Ooh, okay. You got to work on that one.
Yeah.
You just said it. We are recruiting, Paul, by the way. Thank you.
Exactly. What is a typical acquisition for you guys? Is there a typical size you like, or is there a typical revenue number you like?
Well, we're not afraid to do large deals, and in the last 10 years, we've done a number that have reached that billion mark, and we're very proud of that. But really, if you go back to my comment about size of the availability, in the United States, and this is mirrored globally, most of the people who are out there that are private are smaller. And by that I mean our average acquisition size is probably somewhere around 10 million in revenue.
Okay.
It's probably owned by 2 or 3 entrepreneurs, may have started at their dining room table, or their parents may have started it. They've grown the business to a great size for them in their local community. To your point, Paul, they make a very good living. And yet at the same time, if they want to stay in touch with what's happening in the future, AI, cyber, data analytics, et cetera, they need a partner. And that's what we bring. And again, back to the point that we don't synergize out costs and say, come in here, get rid of everybody, we just want your book of business. We want to take that platform and really expand it.
About 30 seconds left, Pat. Just how's your year been so far?
Year is looking great. Thank you very much. The last 5 years have been terrific, and we look at the future, and we're just getting started.
All right. Sounds good to me. The insurance business is a good business. They all tell me that, but I just don't understand it. To be honest, I buy a lot of it.
I was going to say, we buy a lot of it. This is all very true.
That, by the way.
Yeah. Buy a lot of it. Pat Gallagher, he's the Chief Executive Officer of Gallagher Insurance, joining us live here in our Bloomberg Interactive Broker studio. Again, this is a large insurance brokerage firm, so I have to make sure I get that correct. Matt Palazzolo always on top of me about that. But I'm just looking at the revenue, $10 billion of revenue, so it's just really extraordinary.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's check in with a guy who's pretty good on tech space. He's okay. He's not bad. Anurag Rana, our Senior Technology Analyst for Bloomberg Intelligence. Anurag, I was kind of paraphrasing what I think you're going to say about this report that, their iPhone shipments are up a gajillion % here in the latest period. But talk to us about this data coming out of China. How reliable is it, and how predictive is it? And if it's up 50% in the latest period, why isn't Apple stock up a lot more today?
Yes, that's a very good question, Paul. And again, I have nothing against the people who collect this data and figure it out. But this is the way I looked at it. In Jan and Feb, this data was down, I think, minus 35, minus 40% or so. And then when Apple reported their quarter, they said, you know what, mainland China, our iPhone revenue grew. So there is not that direct correlation between the two numbers. And it could be because there are times when Apple, sells phone, but it's stuck in the inventory channel in between. Then they put out a sale and then gets cleared up. So it's a question of timing, not so much. But the big thing for us is that there was a downdraft of negative news coming out of China. It's turned positive 2 months in a row. So that's a good news. Seems more like a cyclical issue to me than a structural problem of people giving away Apple phones, not buying it. So that's not the case. So that's a good news. So I think, from an overall sentiment point of view, I think this is good news for Apple that China, which in our view is the most important market for them over the next 3 to 5 years, and we are not going to see, let's say year over year declining share. I think it's going to be okay over the next few years, even if it goes ups and downs. So that's really the big takeaway for us.
So can I call this a nothing burger?
No, that's not true because
I say that because you didn't hear it, but Paul was guessing you would call this data a nothing burger. But you're being too polite about it, I think, Anurag.
So sentiment-wise, think about it. This only thing that we've been hearing for almost a year now, that people don't want to buy iPhones in China. It's because of the government and nationalism and so many all things. And I think this one tells us that's not the case. People are strapped for cash, and if they get a good deal on a phone, they'll buy it. So what do I expect? I expect Apple to go out and do more promotional activities over the next few months to try and sell more products into the market. Now, not every market is different. Apple's not known to give a lot of discounts globally, but if that's what they have to do in China, that's what they have to do.
All right, fair enough. But let's go to the discounts, though, for a second. So even if we don't take this data as gold, but just directionally, Apple and discounts tend not to go together, at least in my mind. What do you make of that?
Yeah, I think this is a new thing for Apple. And again, they're probably grinding their teeth and not liking it. But you know what? They have the rest of the world to make up for it. In the US, for example, people are liking to buy the higher end model, the Pro model. that helps margins, that helps the average selling price. So if they have to give a little bit up to gain market share in China, I think they should do it, because you don't want to be branded as somebody, a second player in China out there, which is, in our view, the most important market for growth for Apple. Otherwise, what's going to happen is you're not going to see any growth in China. For that matter, their top line growth is not going to grow, and that's not good for the stock also.
Anurag, talk to us about India. What is it as a percentage of Apple's business today, and what do you think it can be 5, 6, 7 years from now?
Yeah, so in our view, Apple's very small, less than 5%. In fact, when we have done a lot of work on the number of shipments in India, Apple's market share is less than 5%. But here's the kicker. 95% of the phones don't even qualify to be in the Apple's, you could say, ecosystem, which means they're under $300. As the Indian economy grows, as the middle class becomes more affluent, I think Apple's going to be a winner over here. But think about it this way. When we look at the US with per capita income of, let's say, $65,000, $70,000, somewhere in that realm, China is around $12,500. India is about $2,000, $2,500. So when you look at these three ecosystems, I think when we look at that growth driver from 5 years onwards, that's where India comes in, and there's a massive market there for Apple, but that's not going to happen next year or the year after.
Right. That's sort of a structural change, et cetera, in the market. Anurag, what else are you working on right now?
I think the biggest thing right now is what happens at WWDC and whether that's going to be enough to sustain this, I would say, optimism that we have seen in Apple for the first time, I would say, in the last 18 months. Because we all knew China was a problem. We saw that in the numbers. Sales numbers are not very strong. But AI has that outside potential to go out and spur the next sale of phones. Why? Because there is a massive amount. Over 43% of the phones are iPhone 12 and below, which is old phones with lower, you could say, RAM memory and other things. Now, if they go out and say, I have really cool features coming into the phone, you got to go find a way to upgrade it. Now, if somebody has a 14 or a 15, they're most likely not going to upgrade it. But if you have something like an iPhone 10, iPhone 11, there may be a reason enough for you to upgrade it. So that really brings a new, fresh, you could say, life in Apple. And that's really important on June 10th when they get this developer conference.
All right, I'm sitting on an Apple iPhone 11. When do I upgrade?
You should update it in the winter when the 16 comes out, or whatever the name they give that phone, because it should have a faster processor. It should have a lot more memory. It'll just make things easier for you. You can watch your golf shows in a little bit easier way.
Very good. Now, Tim Cook, 63. I'm going to switch gears on you. Is there any push for this guy to put out a succession plan of note, or things just going so well at Apple that nobody's pushing for that?
See, Tim's done well. Apple's done very well under Tim. I have no way of predicting when he's going to leave, but I really hope, in my view, if you were to somehow ring fence the China business, Apple alone is a company that I think can do good by itself. It doesn't really need a massive charismatic leader in order to come up with that. This is a company with a global brand, the products people love, people trust the products, and the install base is very loyal. I mean, we think somewhere in the mid-90s, people can keep the phones. They don't go out and change into a new ecosystem. I think this is a phenomenal business, but you do need certain innovation, but not to the level you need in other technology companies.
No, but I wonder if you just need a really good China ambassador within that company.
Yeah, I mean, Tim has been an amazing China ambassador. If you go back even the days when we had China tariff wars, Apple really, scathed unhurt from there. Now, the only issue we have been having in the last 2-3 years is supply chain problems in China because of COVID. Then after that, the consumers slow down, and then a little bit negative, you could say, fights between the US and China, and that has had an impact on Apple. But in our view, if there is a way to ring fence that, I would say, risk. Apple's a good company to look at.
All right, Anurag, thanks so much for joining us. Anurag Rana, Senior Technology Analyst, Bloomberg Intelligence, just looking at the FA function for Apple revenue. The forecast for their September 24th, their fiscal 24 year, $387 billion of revenue. Net income, $101 billion. And free cash flow, of $104 billion.
It's like a lot of money.
That's
like they make a lot of money.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We also take a view of Bloomberg NEF. It's Bloomberg New Energy Finance. They're a research center within Bloomberg that covers commodities, power, transport, industry, buildings, ag sectors, technology, sustainable issues, all to help businesses and companies kind of learn how they can transition as we move to net zero at some point. And today we're going to take a look at offshore wind. Here in the U.S., it's been a real nightmare, particularly here on the East Coast. In some ways, it makes sense. Big ocean, lots of wind, stick a turbine in there, boom, you have renewable power. The issue, though, is many of the issue has been in pricing. The contracts that were signed didn't account for the massive amount of inflation that we've seen in the last couple years, and a lot of projects have then been canceled. So the question really is, what happens now, particularly as inflation comes down? Oliver Metcalfe is head of wind research at BNEF, and he joins us now in the Interactive Brokers studio. Ollie, thanks for joining. We appreciate it.
Thanks for having me on.
So I sort of set up what the problem was. Where are we now with that?
Well, it's been a difficult last 12 months for the US offshore wind industry. We saw around 9 gigawatts of offtake contracts, so contracts for the generation of these projects, get cancelled. That's around a third of the contracts that were signed in total for the US offshore wind pipeline. You mentioned there it was because of high inflation, high interest rates have really hit the technology as well. So it's a really capitally intensive technology, and so a higher cost of financing hits offshore wind especially hard compared with other technologies. We're beginning to see a bit of a turning of the fortunes. So we're seeing the first couple of commercial scale offshore wind projects start to come online in the US. One's already come online off the coast of New York, and one that will feed power into Massachusetts is under construction at the moment. So some good stories beginning. And we're also seeing states willing to adjust their subsidy mechanisms to account for some of the pain that projects have been feeling recently. So offer developers more protection in the contracts, the offtake contracts they're offering, and just simply higher prices that these developers need to make their return.
So talk to us about just wind research. How is wind power, how is that from an efficiency perspective versus solar and versus other stuff that's out there? How competitive is wind?
So you get kind of higher productivity from a wind turbine compared with a solar panel. And that's even more productive offshore. And so offshore wind, you have more consistent wind speed, stronger winds as well. So that means kind of if you imagine a wind turbine operating 100% of the time, that's kind of the theoretical maximum. You can get between 40 to 60% of that generation typically on a wind project. Now that 60% isn't too far off the kind of percentage we could see from a kind of conventional generator, a gas or a coal plant.
Oh, really? What about like nuclear? Isn't nuclear a lot better than that?
Nuclear, it's much harder to ramp up and down, and so they tend to operate completely as base load. So you get really high, what we call capacity factors for nuclear. So it's operating almost all the time if it's part of the mix.
So you mentioned, so part of the issue is the offtake contract. So basically, if I'm a developer, Paul goes and says, okay, I'm going to buy this wind from you for this amount of time. He's going to pay me this, which gives me clarity on then how I can go and invest that money. But my costs go up, and I'm kind of left naked at that point. How is that being resolved? You mentioned subsidies, but like what else? Because that gap is very unpredictable. And I remember talking to Siemens North America head about that, and they're like, we took on all the commodity risk, and they're trying to change that now because they're not commodity traders. But like, how do you do that?
Well, yeah, it's that unpredictability that hit developers especially hard. So in the previous contracts, those ones I was talking about that got cancelled, there was very little adjustment in the contract price to account for moving commodity prices, to account for inflation. So that's the kind of thing that states are building into these contracts now to kind of better share the risk between a state, which is buying the power, and the developer that's building the project. So we're seeing kind of these prices getting indexed to CPI CPI, for example, to certain kind of producer price indexes, and to certain commodity prices, to make sometimes a one-time adjustment from when you agree to that price to when you're actually securing finance. And sometimes you see that adjustments accounting for inflation right throughout the life of the project.
That's interesting.
That's the kind of structure we see in lots of other countries that have managed to build large-scale offshore wind projects globally. And so, from the offshore wind industry's perspective, it's good to see that happening in the US as well.
Talk to us about, you mentioned the project off the coast of New York. Talk to us about the economics. How much did it cost to build that thing? Who paid for it? And just the economics.
So that is a project called South Fork. It was the kind of the first commercial scale offshore wind project in the US. That was significantly more expensive than a project we expect to see getting installed today. That's partly because it was almost like a proof of concept. So up until then, there were only 7 operational offshore wind turbines off the coast of the US so far. So this is the first kind of larger scale project. For one of the newer projects, you're probably looking between $2.8 to $3 billion for a 1 gigawatt project, which is a really big offshore wind farm, almost 10 times the size of that early kind of commercial scale project that just came off the coast of New York. So these are really sizable infrastructure investments,
What part is the hardest? Because it seems to me that, moving the energy from offshore to the grid on land, like you gotta like build a transmission line for that. Like that seems really hard and dangerous. And then I also hear of the transmission plug shortages. So basically the thing you need to actually plug that wind into the grid, there's a shortage of that. And then you gotta build it, and there's all the raw material costs that come with actually building the turbine. Where's the biggest price increases?
Well, I mean, we saw a lot of price increases across the board over the last couple of years. Actually, when you look at a lot of commodity prices that are important for manufacturing of wind turbines, cables, that kind of thing, a lot of those raw material costs have come down. What we've seen is turbine prices have remained stubbornly high. Wind turbine makers were hit just as hard by rising costs, rising inflation, and many of them were having to deliver on contracts they'd signed at cheaper rates in this higher priced environment. So that means many of the kind of major wind turbine makers have suffered a lot over the last couple of years. And so they're maintaining higher prices to kind of have a bit of a buffer on their margin, trying to regain kind of stronger margins. But that means that developers are left paying higher prices for the turbines, despite the fact that some of these input costs have started coming down.
Who makes these big turbine things out in the ocean?
So that's companies like Vestas, Siemens Energy, GE is a big US player. And so those
GE Vernova, I think,
GE
right?
Vernova,
Yeah, there
GE
you go.
Vernova recently spun out.
Ørsted.
I mean, do they?
Ørsted, right?
So Ørsted's one of the companies that builds the project. So one of the biggest project developers globally. But they'll be the guys putting in the orders with your likes of Vestas, GE, Siemens.
Gotcha.
I mean, how do you build these things? I mean, how do you install them? I mean,
Difficultly.
It's tough.
Yeah.
It's tough.
Do I build them on land, ship them out there, then just plug them in the sand? I mean, how does this work?
So most of what's getting built at the moment is bottom fixed offshore wind. So you go out there, you build a foundation that's fixed to the seabed, and then you come out and you build the turbine on top of that. So you build up the tower, and then component by component kind of build the big fan you can see at the top of these turbines.
I know. And then also, then the question is like, if something happens and it's broken, like how do you fix it? Like what's it like when you go offshore? I mean, what happens when one of these things dies? It just like, what's the shelf life of a turbine? And how do you recycle it? We don't know that yet.
Yeah, well, going to your question on what happens when it goes wrong or how you construct it, you need really specialized vessels to build these things. So they call them jack-up vessels. So they're vessels that kind of have legs that they extend down into the seabed. Jacks up the vessel so it's sitting kind of above the water, so you've got a solid platform by which to install the components, or if something goes wrong to send it out there, take off one of the components and replace it with a fixed one. But these are really specialized vessels. They cost a lot of money to build. Our estimates are around $300 to $500 million. And there's a shortage of these things globally at the moment, to the kind of specialized vessels to install the foundations and then the turbines. So if you're a developer, you're struggling to find those slots where you can secure vessels vessels. And if something goes wrong on a recently installed project with one of these big new turbines, then you might struggle to get a vessel to come in and do that replacement work.
How cool.
Yeah, I mean, those engineer people, I don't understand them. They're different.
I mean, it's amazing.
Yeah.
It's amazing. And we think it's all such an easy fix, and it's most definitely not. Oli, thanks a lot. Oliver Metcalfe, he's joining us, head of wind research over at BNEF. That was super interesting. Thank you so much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.